International Monetary Fund, completed its Article 4 consultation in Nigeria, downgrading its growth forecast for the country in 2020 to 2.0% from 2.5%. Now, similarly, the IMF noted the need to boost revenues, tighten monetary policy, reduce deficit financing by the CBN, and implement structural and sector-specific policy reforms. Well, joining me now to look at some of the key issues is the Managing Director of Afrinvest Securities, Ayodeji Ebo. Good morning, Ayodeji. Thanks for joining us on the program. Now, the slow pace of economic recovery, high inflation, increase in external vulnerabilities, and, of course, high fiscal deficits were some of the key factors raised by the IMF that resulted to that downgrade of the forecast. As an investment analyst, what is most worrying for you in all of this?
Yes, I think there's nothing really new, and the concern is that we've been talking about the diversification of our revenue base. And with the coronavirus at the global space that has impacted in terms of the demand for commodities, especially for Nigeria that depends on oil. So we've seen oil prices tank below our budget benchmark of $57 per barrel. And that is expected to impact on the revenue expectation for our budget. If you look at in terms of the actual revenue performance for last year, revenue was around, I think, 4.2 trillion. Expected, and out of this, a major chunk of that is from oil revenue. So with what we're experiencing now in terms of low oil prices, if that is prolonged, that would affect in terms of our oil revenue. So with projection looking at this year's budget revenue, we feel actual too will not be more than about 4.5 trillion. So if that may need to be revised downwards if the oil prices continue to hover below the budget benchmark. Beyond that, they also try to highlight and also welcome some of the development in terms of the Finance Act, which has to do with in terms of increasing VAT from 5% to 7.5%. Also, the one-year budget cycle, where some of the highlights in terms of welcome development. But going back to some of their concerns, they spoke about in some of their earlier reports in terms of about the three major sources of subsidies. We want to talk about the FX subsidy, we want to talk about the power sector subsidy, as well as the petrol subsidy. They've been advocating that these subsidies should be taken out to increase in terms of available resources for government, especially for capital expenditure. Though they highlighted that in terms of the infrastructure development, there's been some form of improvement within that space. But if we really don't deal with some of these major subsidies that will continue to weigh down in terms of available limited resources, that would affect in terms of the growth in the economy. They also try to highlight in terms of our default to the CBN to always to provide overdraft. That is also a concern, because when you look at based on available statistics, is about the current government overdraft with the CBN is about 8.5 trillion. It increased in the last 1 year by about 3 trillion. That's alarming. When you compare it to what it should actually be, it shouldn't be more than 5% of the last actual revenue. If you look at that figure, it means that based on the act, we've been drawing more than what we should be taking.
Now, talking about still the concerns of the IMF still in that report, the fund also expressed the view that there's a need for a tighter monetary policy through conventional methods. Of course, that would be to contain rising inflation. With the recent segmentation of the money market, do you think that the recent CRR increase would be enough to check system liquidity?
No, what CBN, based on what CBN has done was, in anticipation of the maturities, especially from homo maturities, because within these next two months, in terms of maturities, will be close to 2 trillion. So what CBN effectively have done was to reduce in terms of the liquidity in the system within that period, which I think from time to time CBN tries to check the balance before they also debit the bank. So, but effectively, when you look at in terms of the CRR, that further constrain the bank even in terms of lending, because checking effective CRR beyond the 27.5%, effective CRR should be around 40 or 45%. It means it limits the bank's ability in terms of lending. So there's the other angle in terms of the loan-to-deposit ratio, which is currently around 65%, pushing the banks in terms of pushing them to lend as much as possible. We've been seeing some form of traction within that space, and some of the banks are already taking more risk, trying to lend to businesses, trying to lend to individuals but at least by capping in terms of the amount that will be advanced to them. Yeah, but before we begin to see the results of that, it's going to still take some time. But by and large, the liquidity management system, we still feel that may not be that effective because of the maturities. That segmentation. So for most of the pension fund administrators, also the fund managers, they are unable to reinvest some of these maturities. And that will continue to send rates southward, because once you have this excess liquidity, the system, it finds its way. Some of them may also find their way and put pressure even on the FX, because you also, based on the way the rate at which the reserves have been depleting on a week-on-week basis, currently at $37.3 billion. That is also sending a signal to most of the investors to see how long can the CBN continue to defend or intervene, if I will put it in a better way, to intervene in the market.
Now, still talking about the CBN's intervention. Now, earlier on, you talked about the CBN expanding overdrafts. Now, if the CBN continues to expand overdrafts to the federal government, do you think that new tax reforms could relieve the pressure on the federal government's finances?
Yeah, interesting. Based on the perception in terms of the tax reform, so we've seen in terms of the adjustment of VAT from 5% to 7.5%. But if you look at it based on the federal level, the federal government is only entitled to get 15% of this increase. And based on our estimate, we are projecting that for the federal government, we only get additional about 80 billion naira. It's just a drop in the ocean. Cannot do so much, because when you see most of, in terms of the obligations, their debt to actual revenue ratio is close to 60, is over 60%. That's very significant. When you take it in terms of recurrent expenditure, that will be over 100% in terms of actual revenue now, not based on projected revenue. So it's really going to affect in terms of how government will be able to implement, especially from the capital expenditure angle. So that just sends a major signal that the government needs to see how they want to review the PPP policy to provide some form of comfort for private investors, for them to be able to partner with them. If we continue at this pace in terms of government trying to fix the major roads, trying to also fix in terms of, let me say, the major infrastructure in the country, then the pace at which would grow would not be encouraging. We won't be able to catch up with our population growth rate. So there needs to be some form of partnership with the private sector. And what they need to do is to look at that PPP policy again to provide comfort. Enforcement of contract is also very key. And some of the private sector that have invested so far in Nigeria in terms of cancelling some of those agreements always send very negative signal to potential foreign investors. And when you look at in terms of the amount of foreign direct investment that Nigeria attracted last year was very, very little, less than $1 billion. And if you look at our neighboring countries are attracting very significant amounts of investment. So there's a need to look at how do we want to, for us to be able to grow significantly. We cannot continue to rely on the limited resources of the government to fund some of the major projects. So we need the intervention of private investors so that some of those things can be on a BOT, build, operate, and transfer basis, such that the government can have their control maybe later in the year.
All right, while we wait to see all that play out, let's talk about the land border closure now and the 42 items excluded from accessing FX, which are key concerns of the IMF as well. Are we likely to see a change in policy direction?
No, in terms of the land border closure, we're expecting, and based on what the federal government have said, trying to engage neighboring countries. This is impacting businesses because when you look at the trades within both countries is very significant, and that cannot just be ignored. For most of people, especially for quoted companies that also export and sell to some of these countries, their revenue is currently being impacted. So it's government needs to see this be very fast in terms of coming to a conclusion in terms of the process, or come up with a major framework that would be suitable also for Nigeria in terms of, so that this border can be opened, because it will continue to we saw inflation rates yesterday that impacted significantly on food inflation. So if we really don't take care of that, that would continue to impact in terms of prices of most of those commodities, especially food and cars that are being transacted within that space. Then coming to the 42 items which the IMF consultants also highlighted as a major point of concern. For now, I don't think the CBN would link on that based on their own belief in terms of their own policy to see how they want to drive local investments. But the concern is that sometimes those policies to drive the local investments are not really very clear. So it's not about just excluding them from not giving them access to FX. We should have very clear roadmap, or in terms of blueprints, that some of these sectors or items that have been excluded, for any potential investor to see how they want to grow those or produce those items within the country. There need to be very clear goal, very clear direction that people can print out those documents and they can work with it. Most times, I don't feel that some of these, in terms of those policies, are very clear. The latest one is on the milk dairy production. We currently don't have any major document in terms of the terms, in terms of how they intend, in number of years they intend to reduce the importation of milk into Nigeria. In some of those terms that have been signed, or if there's any new company that also decides that wants to go into that sector, there needs to be a blueprint, and it should be very clear before we either intervene or whether trying to exclude, or ultimately trying to see how we want to grow some of those industries within the country.
Now, just as the IMF cited the need for power sector reforms, the DISCOs are already communicating tariff changes with effect from April the 1st this year. Now, how significant are the changes, and what's the likely impact on the sector and the economy as a whole?
Yes, just to provide some form of background, there's after the privatization in 2012, there's this what we call the multi-year tariff order policy in terms of to help guide in terms of pricing of the tariff within the power sector. But what we've noticed is that since 2015, there's been no major review or minor review. There's supposed to be a minor review every 2 years, and a major review every 5 years based on several factors, because they look at the exchange rate, they look at the inflation rate, the growth rate. There are a lot of factors that determines that pricing, because there are a lot of inputs from gas in terms of the equipment that fits into the cost. So that has stalled in terms of the development of that particular of the power sector. So what would do this major review, if it takes effect in April, what basically it will do it will open up that sector for potential investment. So we've seen for most of especially looking at the DISCO, they've not been able to access new funds, which should help them in terms of improving in terms of their efficiency. Because beyond just the upward review of tariff, they also have targets in terms of what the technical losses and commercial losses that they should achieve over a particular period. So if they are not able to invest in new equipment, if they are not able to invest in metering so that they can enhance collection as much as possible, though the MAPS program has assisted in that, then they will continue to be shortfall in that space. Government has spent close to about over 1 trillion within the last 3 or 4 years, 1.7 trillion rather, in the last 4 years to bail out that sector. That's another form of subsidy. So what we believe that this review we do would be that it would open up that sector for potential investments. The capital market is also a potential way for them to be able to fund businesses within that particular space.
All right, Ayodeji Ebo, Managing Director of Afrinvest Securities, many thanks for sharing your thoughts with us this morning.